Portfolios with Purpose is a fantasy stock trading contest where you can win money for your favorite charity. The contest is now open to high school and college students. Students have the opportunity to learn about investing, network with professionals, compete with other schools, and build their resume. Today, I will offer some tips on how to pick a stock to create a winning portfolio. Here's how to get started. Buy what you know. Start with a company that's familiar to you. If Lululemon raised prices on your favorite pair of workout sweats, or Chipotle upped the price of its burrito bowl, but you have to have those items, that's inelasticity of demand, and it's probably a good thing that Lululemon and Chipotle can keep price, which inevitably means it's good for the earnings powers of those companies. Now, there's more to it than just that, but keeping abreast of trends and applying your mentality as an everyday consumer or purchaser of goods can make you a leading indicator for stock investing. Consider price and valuation. The most common metric for valuing stocks is price to earnings. What is the price you are willing to pay for that earnings stream? It's a relative value game. Here's an example. If I told you a basket of stocks like the S&P 500 was trading at 20 times next year's earnings, and the weighted average growth of that index was 5 to 10%, but a home builder like D.R. Horton could grow 15 to 20% over the next few years, and it's trading at 11 times earnings. That, to me, is a buy signal for D.R. Horton. How could it trade at a sub-market multiple for something that could grow 2 to 3 times greater? DHI, D.R. Horton, may be a really undervalued stock. Identify a catalyst. Don't just invest on the basis of price. Find an event unlocking, which will allow for share price appreciation. Look at company earnings transcripts or presentations to see if management has hinted at doing share buybacks, special dividends, asset sales, or maybe even spinning out underappreciated non-core assets. It could be that the company is the perfect strategic fit for a takeover like Microsoft's acquisition of LinkedIn last year. Good management teams are important. You want to make sure your interests as a shareholder are aligned with management teams. Does management have significant skin in the game? Are they compensated in stock or out-of-the-money options? If so, they are incentivized to create shareholder value. CEOs, CFOs, and board of directors' fiduciary duty is to drive share price. Make sure management teams are seasoned operators and have track records of successfully growing revenues and cutting costs. Start digging into the company's financial reports. Look for consistent history of profitability and financial health, not just one good quarter. And make sure to check the investor relations section of a company's website or find official reports filed with the SEC online. Don't just focus on the most recent report. Check the company's balance sheet. If a company is generating sufficient cash to pay down or refinance debt cheaper, that can serve as a catalyst for earnings windfall. Find a dividend. A dividend, a cash payout to stock investors, is a sign of a company in good financial health. If a company pays a dividend, look at the history of their payments. If a company isn't steadily profitable, scratch it off your list. So to recap, number 1, buy what you know. Number 2, consider price and valuation. 3, identify a catalyst. 4, good management teams are important. 5, start digging into the company's financial reports. And 6, find a safe dividend.